kickstart this segment, we have a presentation on the role of digital infrastructure for pandemic response, comparison of 11 programs by Olivia White, McKinsey and Company with our moderator, Kabir, Kumar, Flourish Adventures.
Hello, my name is Kabir, Kumar. I'm with Flourish Ventures. We are an evergreen fund. We back entrepreneurs whose innovations help people achieve financial health and prosperity and help build a fair financial world. I am thrilled to bring to you today an exciting and important panel on the future of the digital infrastructure for finance in the United States. By all measures, the United States government responded sizably and swiftly to the pandemic, approving a pretty sizable package, 3 times the response to the 2008 financial crisis. I think the last numbers I've looked at, 12% of 2019 GDP, more than Germany, more than other countries. While Congress moved swiftly and the response was sizable, what followed exposed weaknesses of the retail financial system, especially key infrastructure components around payments, identity, data. For example, in July, after many countries had already dispersed stimulus payments to the most vulnerable population almost in minutes, millions in the United States had still not received their money, which was being distributed through prepaid cards. In the absence of a national identity system, some payments were sent to deceased people, fraudsters exploited unemployment programs. As we look ahead, there's going to be another set of stimulus measures. We need them. There's a new administration and a new threshold movement. We can learn from the lessons of the pandemic and build a better future. My panelists, who are experts in different aspects of the infrastructure components, passionate believers in the future, and I will talk through the lessons we learned and what we can do to address it. We will start with a short presentation from Olivia White, partner in the McKinsey San Francisco office, on a unique study that compared the effectiveness of 11 pandemic response programs across the world, including Singapore and the United States, looking at key infrastructure components, payments, identity, data, and how those components made it possible for those programs to be effective or not. Over to you, Olivia.
Thank you, Kabir, and welcome everyone. It's a real pleasure to be here. So as Kabir said, I'm going to talk through this piece of work on COVID-19, the value of digital ID and of financial data sharing, all against a backdrop of what matters around digital financial inclusion. So first is a bit of a preview of what I'm going to talk about more broadly. As Kabir said, the pandemic really stress-tested financial infrastructure in the US and globally, and it made it critical to understand the gaps and the opportunities that countries face, just because the imperative of getting money to people was so high in many cases. And in this piece of work, we looked at 11 government economic disbursement programs across 6 countries. We looked at programs that covered SMEs and individuals both, and we asked, was the availability of financial infrastructure important and how to the effectiveness of the programs? And we found that 3 structural features needed to be in place for programs to be successful. The first was broad digital financial inclusion. So this means digital channels for fund disbursement, including the payment rails. The second, a presence of a basic digital ID system with broad population coverage that allowed authentication over digital channels. And third, simple data on individuals and businesses that was tethered to the ID that allowed appropriate disbursement. And the fact is that in places that had these features in place, disbursement programs were largely successful. And places that did not have these features in place needed to make trade-offs. And they needed to make trade-offs either in the ambition of their design, how large were the programs, how specific were the programs, how targeted were the programs, or in the success of their delivery, the actual execution. Were programs sufficiently fast? Was the coverage broad as intended? Was fraud limited or not? And there's a broad and more general point around all of this, which is that for resilience really to hold in these sorts of crisis situations, governments really do need to make sure that these elements of robust financial infrastructure are in place now, but also going forward. So now let me turn to some of the details of the work. So the 11 programs span 6 countries. So we looked at programs in India, in the US, in Brazil, in Nigeria, in Singapore, and in the UK. And we looked at programs of a couple different sorts. So we looked at 5 programs that targeted individuals directly, either relatively broad programs like the economic impact payment in the US, which went to everybody that had an income less than $75,000, or programs that were more targeted to vulnerable populations, as one saw in India, for example, or in Nigeria. We looked at a few business-targeted disbursement programs, so direct disbursements to businesses, largely with the aim of providing the ability to pay workers' salaries. And then we looked at business-targeted loans, collateralized either entirely or in very large part by the government. And we asked, how effective were these programs? So, as a bit of a groundwork, for each of the programs, we first said, were the required financial infrastructural features in place? And as a bit of a graphical illustration, we looked at the answer to this question on a triangle. So first, look at the left-hand side of this page, where we characterize what was in place for the job support scheme in Singapore. And just a little context on the program, it was an example of a successful program, and we can maybe say a little bit more later, where effectively the Court Pass business ID system enabled the ability to identify and therefore pay businesses using simple business data, so things like tax information and payroll history. And we looked and we said, look, what were these 3 structural features in place? And we graphically showed that on a triangle. So you'll see on the bottom left of the triangle, we characterized the degree of financial inclusion, that is access to a digital account and digital payment rails of the recipients of the program, so businesses. Top of the triangle, we characterized whether there was a basic authenticating digital ID system in place, again, for the recipients. And then on the bottom right of the triangle was their simple data tethered to that digital ID. And the purple outline signifies that in the case of this job support scheme in Singapore, all of those 3 features were in place. As a separate example, we considered, for example, the conditional cash transfer program in Nigeria. And this was a program that was built upon a partial social registry that was already existing, that covered only 12% of households living in extreme poverty. So it was by necessity, unfortunately, having to start with a sort of limited registry. And disbursement had to be done in cash because a lot of these people, many of these, or if not all of these people, weren't financially included. And that corresponded to these infrastructural systems or these infrastructural characteristics not being in place. So you'll see the right-hand triangle, level of digital financial inclusion, sort of structurally low, digital ID effectively not in place, and very little or limited data tethered to that ID, partially because of the partial registry that it was based upon. So 2 programs with rather different structural features. Now, this is all a bit of a wind-up to saying, as we looked across all of the 11 programs that we examined, we found that they fell into 4 categories. And here are those 4 categories with 4 example programs. So first, there were some programs that showed design, delivery, and success. The job support scheme was one. More in a moment. Second, in some cases, when not all of those structural features were in place, programs had to sacrifice delivery. The Paycheck Protection Program in the US is an example of such a program. Third, in other instances, design was sacrificed. And that was a case, for example, with the Guaranteed Emergency Credit Line in India. And then fourth, there were programs in which sacrifice or trade-offs needed to be made both in ambition and in the success of the delivery, which was the case in the CCT in Nigeria. So just as a quick zoom on the job support scheme in Singapore, as I outlined on the previous page, you'll see the first first column of triangles. The financial infrastructural systems or elements were in place, leading to the next 2 right-hand triangles, where we look at design ambition and delivery success, both of which were high. And the way you see that, first for design ambition, we've shown graphically what was the scope of the program, what was its scale, and what was its specificity. That is, was it able to be designed in a way that actually targeted and treated differential populations differentially? And the basic outcome for the JSS was quite high. And then we said, was the actual delivery successful? So were funds dispersed quickly? The speed high. Second, was fraud low? And third, was coverage, that is, the people who received the money as intended in the design. And again, in the case of the JSS, very high marks. As another example, let's look at the Paycheck Protection Program in the US. That was a case where financial infrastructure underpinning the program was, at least on a relative basis, relatively high, associated with the digital payment rails, in the sense that there was at least strong digital connection or the potential for it between banks and the disperser of funds, so the Small Business Administration. One can say a variety of things about the way that that system worked and its smoothness of operation, but it was in place. The design ambition, scope and scale broad, specificity a little less broad, but nevertheless with a particular set of businesses that were eligible, at least in sort of design and principle. So not terrible on the design ambition front. However, if one looks at the far right-hand side, delivery success, far more limited. So speed was sacrificed in many instances, fast in some, but not in very many. Fraud levels, as we've all read about quite a lot, very high, at least compared to what the ambition would have been. And coverage was not what one might have hoped, particularly with more vulnerable businesses. So precisely the businesses who one was perhaps most eager to be able to reach were the ones that were less able to get the funds, even though they were in principle eligible. Now, I won't talk through the other lines here, but the logic is similar, and you can see graphically the point of the trade-offs in the four categories. And one can look at this across all 11 programs. Now, this page is a little bit of an eye chart, but the important aspect of it is that one can see that there were some programs that really did achieve both design and delivery success, at least on a relative basis. But there were many for which delivery was sacrificed, design was sacrificed, or there were real limitations both on the design and the delivery front. And the sort of graphical triangle representation that I talked through on the previous pages bears out here as well. Now, everything here, everything I've said so far, is with respect to individual programs. And obviously, these individual programs mattered tremendously, both because of their scale, and Kabir talked about this a little bit earlier, but also because many of these were directed to really very vulnerable populations for whom getting money quickly and as intended really was quite essential. But the fact is, this also matters from a macroeconomic perspective. And though it's not on the page, let me just share a couple of numbers, and this is all forthcoming in research to be published shortly. Backdrop here. We as McKinsey Global Institute published work in 2019 that looked at the potential benefit enabled by digital ID, and found that across countries, the potential uplift for digital ID that was linked to appropriate but well-protected and good practices to protect data, digital ID, could increase or boost GDP at the country level between 3 and 13%, depending on the country and factors like the starting position and the nature of the economy. That's the backdrop. We then said, does that number change in the presence of these sorts of government payments, unprecedented government payments that we saw during the COVID pandemic? And indeed, we found that potential value at stake associated with having good digital ID, data tethered to that ID, and then the digital payment rails could mean that the value at stake went up by a factor of up to 1.2. So for example, in a country like Brazil, where the potential value at stake associated with all of these things in good times, we found to be upwards of 13% GDP, that number could boost to 16% of GDP in the presence of something like the payments that we needed to make during the COVID pandemic. So this matters on an individual program level. It also matters on a macroeconomic level. But how to go even beyond that and to think, what are countries' abilities to be to be resilient in the next crisis or in the next instance in which a country has a real desire to get money, to get loans to its population quickly or in a particular and targeted way. And this shows graphically how to think about, or a nice way of thinking about, where different countries stand. So the hexagon illustrates the elements of digital financial infrastructure, both as respect individuals and respect businesses. And you'll see on the left-hand side of the slide a pictorial key for what you're seeing here. The top three vertices in each of these hexagons, from left to right, show the level of the population who has access to digital channels for payment disbursement, the sort of measure of digital financial inclusion. Then next, population with digital ID, and next, population with relevant data linked to that ID. And the top three vertices are for individuals, the bottom three for businesses. If you look at what this means for individual countries, first look at Singapore. So Singapore has a rectangle that's almost entirely filled in. Good levels of digital financial infrastructure, albeit with some gaps on the individual side associated with digital ID and data tethered to that ID. By contrast, look at a country like Nigeria, or in fact even the United States, where you see that the general size of that rectangle is the hexagon is very small. They're then countries in a sort of intermediate position. So you'll see, for instance, India, with the digital financial infrastructure broadly for individuals, is very strong, again, with some areas for improvement, and for businesses leaves some real room to be desired. Or the UK, where on the business front things are strong, but there's not that same infrastructure in place, at least on a sort of systematic basis for individuals. And what this means is, in a country where that rectangle or that hexagon is big, the degree of resilience or flexibility, ability to design programs with the intended aims, very high. And in some sense, the JSS in Singapore was an illustration of that. In countries where the rectangle, I keep saying rectangle, so where the hexagon is small, the flexibility is significantly lower, and that has real implications for forward-looking resiliency and forward-looking flexibility in how programs are designed. So just to close, I'd like very much to thank Kabir for his partnership in much of this research, which in some form will be forthcoming very soon.